Hello and welcome back to the Fixed Income Securities series of animation. Let's continue with the previous chapter, that is the role of regulators. So, for ease of understanding by investors, CRAs generally assign letter grades for their view of the instruments. The highest quality, that is safest with lower yielding bonds, are commonly referred to as AAA, while the least creditworthy are termed as junk. Common scale of ratings AAA to BBB minus, that is investment grade. Then double B plus to triple C minus, that is non-investment or junk grade, and B is the default rating. For short-term scale, we have the ratings from A1 plus to D. Ratings may also be issued for an issuer or a country's sovereign issuer. Rating is called issuer default rating, that is IDR, which refers to the probability of issuer defaulting. Advantages of credit rating. The CRAs are provided with the bulk of information by the issuer, and they take into account the private as well as public information about the company and its management, along with its financial position, to give a simplified riskiness rating. CRAs take complex data and general information and transform the same into an easily understandable form for the investor. The rating information is available to the investors freely on the website of the rating agency. If the rating is accepted by the issuer, for the investor seeking such information from the websites of rating agencies is costless. The credit rating provides relative riskiness of the instrument in clear form and also guides the market about any rating downgrade or upgrade at regular intervals. A consolidated history of rating migration of corporate entities may be used for understanding the possible probability of default level in the country vis-a-vis other countries. Rated instruments can be compared across global markets, and the global investors can easily understand and interpret the risk of investment in a debt instrument. Credit rating agencies are independent institutions, and their opinion on riskiness of an instrument is important for investors. However, as the issuers pay for the ratings, an inherent conflict of interest is built into the system. Credit rating also helps companies to improve their own image. A company with many high-rated instruments would be regarded as a preferred investment destination by many investors, including the collective investment schemes like mutual funds. Credit rating aids investors in decision-making choices between comparative investments with regards to risk identification, issuer credibility, independent opinion, and view about the potential risk, wider choice, saving in time and resources. For understanding riskiness of the instrument and benefits of intensive surveillance by the rating agency. Credit rating is also beneficial to the issuing company as rated instruments make it easy to sell debt, lowers cost of borrowing, opens up a wider market, facilitates image building for the company, and are particularly beneficial to the new and unknown corporate firms. For corporate bonds, default risk gauges the possible capacity of the bond issuers to make payment of the contractual interest and principal on agreed dates. Default risk is the qualitative representation by the credit rating of the issue and the possibility of default increases. If the rating is downgraded by the rating agencies during the lifetime of the instrument, it is quantified as probability of default (PD) associated with the bond rating category. PD is measured using historical annual default rates of bonds in different rating categories. Rating migration is the possible change of rating, both upgrade and downgrade, of an instrument before its maturity. From the table below, we can interpret that 87.19% of companies retained their AAA rating, while 8.69% of the companies that were rated AAA were downgraded to AA, and 3.37% of the said AAA rated companies did not seek rating continuation of the 1 year. The diagonal of the migration matrix is very important to understand the relative riskiness of a market vis-a-vis other global markets. More percentage of companies retaining their original rating or showing improvement of ratings leftward move is an indication of stability of the market. This is chart 1.3. This is a 1 year transition rate from AAA bonds to the D category bonds. A credit rating downgrade of the bond issuer impacts the spread over the risk-free yield curve at which the corporate bond is valued and thus translates into potential mark-to-market losses on a long bond position. A rating upgrade can similarly lead to potential mark-to-market losses on a short bond position. Rating migration risk is quantified by rating transition probabilities established by CRAs. Each CRA has its own methodology for these matrices, which are used for valuation of the instruments. Accurate and reliable default and transition migration rates are important for all debt market participants, as they are crucial inputs for valuation and pricing of debt instruments and loan exposures. They allow investors and lenders to quantify credit risk in their debt exposures and decide on the pricing. These are also critical inputs for credit risk assessment models. The top global CRAs are Moody's, Standard and Poor's, that is S&P's, and Fitch Ratings. Some of the prominent CRAs in India are the Credit Rating Information Services of India Limited, that is CRISIL, ICRA Limited, Credit Analysis and Research Limited, Fitch Ratings India Private Limited, Brickwork Ratings India Private Limited, Equate Ratings and Research Limited, Informatics, Informatics Valuation and Rating Private Limited, that is IVRPL. We will cover the next chapter in next video, that is role of monetary policy in debt markets. So that's it for now. Thank you.